Good afternoon, everyone, and thank you for joining us this afternoon for the second Economic and Market Update webinar. For those of you who don't know me, my name is Sam Petts, member of the Clarion Investment Committee, and I'm delighted to welcome Toby Ricketts to the webinar as well, CEO of Margetts Fund Management and also a member of the Clarion Investment Committee. Toby will be running through an update for you for about 30 or 40 minutes with a few questions at the end, and there are some slides to support his presentation. Over to you, Toby.
Thanks, Sam, and good afternoon, everybody. It's quite an interesting time, really, to be talking about stock markets because often when prices are high and markets and fund performances are at all-time high levels, they can be some of the more difficult periods to find good assets to buy. Where you see attractive valuations. Often, when things are towards the top end, actually values are full, and sometimes you see a bit of overvaluation. And at the moment, we see the reverse. We know markets have fallen a bit, and that's definitely caused a bit of concern and anxiety. But as a result of that, it's left quite a lot of opportunities, we think, assets that we can purchase into where we feel really confident of the future value. And the analogy I've got for this is if you've ever been swimming, when you're on holiday or what have you, you come out of the pool and you can't quite hear properly, and you know there's some water in there, and it's really irritating. Markets have felt like that for the last few years during this period of quantitative easing and central banks buying assets, effectively printing money. It's created an environment where the behaviour of markets hasn't really fitted with what we would always expect. What we've seen really this year is a change in market values and sentiment, which is a bit like that moment when you sort of feel the water dribble out of your ear and suddenly your hearing's restored. And we're seeing markets now operate much more as we would expect, and therefore providing that sort of environment to make sensible decisions and get appropriate rewards. In terms of sort of starting to think about where we are and what the opportunities are, we think this is one of those moments where you've really got to think back quite a long way and understand how we got here. So for the first time in several decades, one of the key topics is inflation. And anybody who's been reading the press will know that inflationary pressures have surged quite considerably this year, and we started towards the end of last year. But if we go back quite a long way, the last time we saw high levels of inflation was really in the 70s, which a period of renown for rising prices. And there's a couple of things happening there that I think are really relevant to considering where markets are today. The first is the 70s was a period of a lot of mistrust globally. Relations between the West and Russia particularly were at a low point, and therefore so was global trade. And also it was a time of quite high levels of growth in Western economies. There was real advances in technologies and a rise in living standards, and therefore quite a lack of people willing to do or able to do the more lower paid jobs. And this led to, there's a lot of factors, but we saw a lot of wage inflation, which is one of the primary causes in the 70s of inflation. And as a result of that, a relationship emerged between the US and China. China was admitted to the World Trade Organization. That made trade an awful lot easier, so a maximum amount of tariffs that could be applied to members within that organization. And so through the 80s, the US really offshored a lot of its lower labor requirements, manufacturing to China. China was very pleased for the significant economic stimulus that resulted in, and we saw a period of falling inflation that really lasted several decades. So this ongoing reduction in manufacturing costs meant that what we often call white goods, washing machines, and so on, just became cheaper and cheaper. And there was a period of emerging trust. Relations between Russia and the West and China improved. Russia and China adopted more market type outlooks, and as a result of that trust, global trade really accelerated, and that also reduced inflation. Something I might have said before is a line I repeat quite often, but the word credit actually is based on the word credo. It's a Greek word for trust, And so, it sort of makes sense, as where there's more trust, the cost of credit is lower. You're much happier lending money to somebody you trust for little or no interest than to somebody you don't trust. You want to charge more, or you don't lend at all. And so we had this period of emerging trust, and it made the job of central bankers quite easy, really, because throughout this whole period, inflation was reducing, and it meant we've had an era of very low interest rates. So I think that's one factor that I'll return to. The second, really, thinking about where we are at the moment, I think relates to the recent cycle, which we think really began in 2008-9 with the global financial crisis. And I think this is an interesting crisis, because at the time there was really what we can now see was a huge amount of complacency in terms of how trustworthy banks were. There was sort of a general view, not just amongst clients, amongst professionals, that banks could never fail, and therefore people shopped around for the best interest rate, and an awful lot of investors put money into Icelandic banks, for instance, with not even a thought that those banks could fail. It was just chasing the highest interest rate. And of course, what was happening behind the scenes is these banks were lending money irresponsibly to people with no jobs and mortgages and so on. And there's creating a lot of toxic assets within the system, which went really largely undetected. Even when Northern Rock failed in 2008, which was almost the canary in the mine type situation, there still wasn't a realization that there was a problem within the banking sector. And then there was almost total shock, really, when all of the big banks had to disclose that they were technically insolvent, and one of the big banks failed altogether. You remember Lehman's. And so policymakers had some difficult decisions to make, because the only evidence they really have of a banking failure went back to the late 20s, where a run on the American banks led ultimately to a recession, and then a depression, and then essentially what became the Great Depression. And so politics was pretty sure that wasn't the right way. In that case, they essentially let savers lose their money. That was the court. So that was off the cards. The other option would be to push taxpayers into bailing out of these banks. Well, within the democracy, those sorts of decisions are very unpopular and often lead to political parties losing their seats at the next election. So that wasn't the answer. And Gordon Brown and the Labour government at the time hit on quantitative easing, which seemed to be a way of resolving these problems without anybody really needing to pick up the bill. And this was a process of printing money through the magic of markets, propping up bank balance sheets so they could survive, so savers could still access their money, and bringing down the cost of borrowing by essentially printing this money into longer dated instruments. And that then detoxified all of these assets, which were extremely vulnerable to high interest rates. And by keeping borrowing rates very, very low, it really meant that more people with mortgages could afford them, and therefore it kept the defaults at bay. And it was so successful, it was adopted, like many things, like the telephone, the internet, the jet engine, a British invention, and then it was wholeheartedly adopted by the Americans, to the point where I think most people would probably even think the Americans invented quantitative easing. And this idea that started very small just grew steadily. And it was one of those things that was never really, no one was going to stop quantitative easing whilst there was no obvious negative side effects. And so the original QE in the UK, I think, was 200 million. The first one in the US was 700 million, but then it rose steadily to the point where we got into the pandemic, and it became the only real tool that was available. And so the level of quantitative easing that had already crept then into the single trillion digits then hit sort of 15 trillion. Well, the figures vary, but 15 to 20 trillion globally, which is an awful lot of money. And the reason this is important is because in your heart, there's just an understanding. If you print money, without a corresponding increase in the size of the economy, it creates inflationary pressures. Doesn't mean it creates inflation, but it creates the pressure. And through all of this process, we've seen upwards inflationary pressures starting to grow, but they weren't released. I mean, just an aside, anybody who's played Monopoly knows a lot more about inflation than they probably think, because with Monopoly at the start of the game, money supply is very limited. We all start with £1,500 and we try and buy assets, and we've not got enough money to buy the assets that we want to buy, but all of the assets are very cheap at the start of a game of Monopoly. But the QE process, every time we pass go, $200 into everybody's pockets. There's hardly any tax in Monopoly, just a bit. So the money supply grows rapidly throughout the game, and as we know, everything gets rather more expensive. And that's exactly really what was happening on a much larger scale in the global economy. But these pressures were suddenly released very urgently. So if we think about what happened in the pandemic, economies had to be closed to reduce the spread of coronavirus. So supply chains were essentially shut down, but demand was shut down too. Everybody had to sort of sit at home and avoid contact. Now, politically, the objective was to release people as quickly as you possibly could, because that was popular. But you can see economically, that's not a sensible thing to do, because you've got all of these buckled supply chains that ships haven't been moving around the world in the usual ways, things aren't where they're supposed to be. And your firm intention is to release the demand in the economy as quickly as you possibly can. And I think it's a great credit to Western economies and markets that the problems of COVID were resolved so quickly in terms of PPE, in terms of testing, then in terms of the vaccine strategy. Quite astonishing, really, how quickly Western markets dealt with that. But it did result in then a very rapid release of demand, and the supply chain wasn't ready, and it created inflation. And central banks thought it was temporary, but actually all of those pressures that have been built through the quantitative easing process, we think, were sort of released as a result of that decision. I'll just touch on economies. It's very interesting to us that places like Russia and China were far less able to deal with the pandemic. So their vaccine strategies, their PPE strategies, China's still dealing with lockdowns. We think it shows how effective free markets are, democracies essentially dealing with change. And when things change rapidly, there was a big demarcation, I think, between how the West responded and how what we've seen so far in Russia and China. But this led to surging inflation, a lot of which would have been temporary. But then something happened on exactly the same day, believe it or not. On the 24th of February, the very last restriction of COVID was released in the UK. And on that very day, Russia, to everybody's surprise, or certainly to our surprise, decided to invade Ukraine. And in doing so, sparked inflationary pressures in oil, gas, basic foods and grain, and so on. Not just that, it clearly then reversed all of the globalization that had been running since the 80s, because trust in Russia, which was already falling, collapsed. And then Russia's potential allies, China being one of them, you've seen the West become more nervous of China, wondering which ways it's going to go. And the result of all of that has been a rapid increase, really, in inflation. And to us, the inflation outlook now has changed, going forward from that sort of 2% target. We think that's unrealistic. And actually, there's too many factors here that can't be controlled by central banks. We think you've got to accept inflation at 3.5%. And what that's done is change the amount of interest that's payable. Interest rates, central banks are increasing interest rates to try and control inflation, and the returns that you get from gilts and lending money to governments over time have all gone up. And that's been the moment of pop. Yields were so low for so long, and yet we kept saying to ourselves, these yields cannot be right at these levels, and avoiding that risk. And yet they were maintained for so long, you almost wondered if you'd got it wrong. And yet when the moment came, we saw yields rise, and in the UK we had another special catalyst, which was the mini budget, which sort of showed that no, the UK certainly wasn't learning that quantitative easing couldn't carry on forever, and that pushed our borrowing costs up significantly. And it all happened very quickly. And in doing so, it sort of reset markets. There'd been this old expression Tina, there is no alternative. What that really meant is you have to buy assets, investments, because cash and bonds yield so little. And now we've moved very quickly into what we call TARA, which is there are reasonable alternatives. You can now get a reasonable return from a bank account and from a bond, and so on. And that's what has made markets quite interesting. The process of that has seen some assets fall in value, and of course we've had exposure to some of those. But what we would regard as temporary capital loss, which over any investment journey, you expect periods of time when you lose money, and actually that's fine as long as those losses are recovered, and they're recovered, in a reasonably short period. What we've seen elsewhere, though, and these are the areas that we've avoided, but there's been some permanent capital destruction. And so the first place to look really is we now know who paid for the global financial crisis, and it was actually pension funds, because as the government printed money and pushed the price really of these long bonds up as the yields came down, it was pension funds that had to buy them, final salary pension schemes. And they essentially lend money to the government over a long period of time and match it against the liabilities of pensioners that they're expecting to pay. If we go back a year, we issued in the UK a bond, which I think it's a 25-year bond, and it was yielding just 75 bits, so less than 1%, and it was issued at £1. And after this big change in borrowing levels, that bond fell to about 40 pence. So the capital loss was 60% of that bond. It's recovered a little bit, but it will take forever to recover to its original value. And when we think that all of those assets, or a large part of them, were in pension portfolios, and they've permanently lost capital, and you add up what the true cost of the banking crisis is, you can effectively see that this debt that's been, or this obligation that's been floating around, who's actually going to pay for it, has been paid. And I think part of that is what's now what's normalised markets. Other assets where we've seen permanent loss of capital, well, in an environment where interest rates are very, very low, businesses that have what we call a hockey stick business model, where their profits are going to grow rapidly into the future, they become very attractive, because generally they need to borrow money initially to get the business plan off the ground, and then the profits will come later. And that high levels of money supply and low borrowing costs very good for those businesses. When we see things change, as they have recently, it goes the other way. The best example we've got really is Meta, previously called Facebook, and that's fallen about 70% now from its high. And if we remember what a darling stock that was, one of the biggest companies in the world, to see that sort of loss, which you normally associate with just a smaller company, a very risky stock, it shows how quickly things have changed. Tesla as well, especially with Elon Musk's recent antics, that's looking vulnerable. And we think, although we've seen quite a lot of pain, we still think there's a bit more to come on those big sort of technology-based hockey stick type businesses. But also private equity, fortunately, not really been that popular from a retail investor's point of view, but institutions have been putting a lot of money into these private equity funds, very heavily geared. The cost of borrowing, we think, will cause them some losses, and maybe even commercial property. So we've seen quite a lot of bad news, with a bit more to come. But out of all of that is a really good opportunity, because if we buy bonds, if we put government bonds in the portfolios now, we're getting 3 to 4% returns. Very good credit rated companies, 6 or 7%. These are much higher levels of returns than we were seeing a few years ago. And if we look at stocks outside of the US, so the UK, Europe, so on, a lot of them are trading on only 4, 5, 6 times their earnings. So that's quite cheap, that you only potentially have to hold a stock for 5 or 6 years to get your money back. So I'm pretty sure I said quite a lot there. What I'm going to do is just share my screen and go through some slides just to support really some of those points, just to look at those visually. So I'll just start with this slide, which is inflation. I think I tried to paint a picture really about inflation in the 70s and how low it was in the 80s and 90s, and then what's really happened. And they've got this long-run inflation expectation at 2%. When economies reopened, inflation pinged up, and then we had the Russian invasion. Something that we have to think about: inflation is a measure of change, rate of change. So if a price goes up but then stays there, inflation goes up but then comes down to zero. And what we're seeing now is that actually prices are starting to stabilize, some are falling. So much as we've seen this big jump in inflation, we actually think we're going to get a lot of relief on the way down as inflation appears to moderate, only for it to come back up again, because it's a shock to the system. It's like a skipping rope. And the reason for the secondary inflationary effect, please ignore the timing and the numbers. I'm just trying to put across a general picture here. But we're now seeing the secondary effects of inflation, which is wage demands, and the wage demands sort of feed into the economy then later on to cause a second wave and possibly even a third wave. I think what you can see from this graph is that whilst the pattern is probably right, the timing is going to be very difficult to predict. Exactly when the prices will go up or down, and what will central banks do. There's lots of scope here for anxiety and relation, and things look good and then bad, and interest rates look like they're going to go up and then down and down. And we don't really intend to try and manage those types of very short-term outcomes. But what we can see, sorry, I just clicked on, is that this 2% inflation that we've had for a long time in a fairly in a world with high levels of trust and with quite high levels of security, actually we think future inflation is going to be between 3 and 4% rather than 2%, and that means that interest rates are going to be higher for longer as well going forward. Central banks are raising interest rates to create a recession to avoid inflation, but when inflation is global rather than domestic, will central banks keep pushing interest rates up and create a deep recession to try and fight inflation where there's not really a realistic chance of pushing it down because it's external? So we think central banks will moderate their targets over this next cycle and think much more about a 3 or 4% inflation target. Just to support inflation falling, the left-hand chart is this is Dutch gas futures, and the right is the oil price. And we can see these big rises that we saw through 21 and into 22 that push this inflation, but a lot of that's reversed. So those price rises are reversing and coming down. There's lots of sources of inflation, but energy is one of the big elements. And so just to support this view that we are going to see this whip down, this data coming through now really supports that. And I mentioned how well Western economies dealt with COVID. We're also seeing the same with energy supply. The mix, it's not great for the environment, but coal-fired power stations are coming on board. They're converting gas stations to run on oil. There's gas tankers dropping liquefied gas off here, there, and everywhere. The German reserves are currently 100% full, even though we're a good few weeks into the winter months. And so Russia was intending to use this as a bargaining tool against Europe, but the economies have really shifted to reduce demand, reduce consumption, and increase supply. And that's why this big feared sort of rout of gas hasn't occurred and prices have moderated. So that's definitely comforting this sort of extreme inflation position in the short term. This graph shows where interest rates have been for the major economies for a long time, and they're about 4%, which is where we expect them to sort of essentially moderate through the next cycle. Now, the purple line is what we would have said in the last presentation. We thought it would happen over a few years, and actually it's just popped. The markets, because of these very high inflationary pressures, and essentially I think because of the Russian invasion of Ukraine, what might have been a slow adjustment has been a much faster adjustment. But I think you can see where the averages are. You see that big inflation during the 70s and 80s. Central banks are a lot smarter now, and they've learned those lessons. But there's scope to return to that long-term average and possibly even a bit over it in the shorter term. Just so you know, the graph that I've inset there shows really that technology stocks, companies with high capital expenditure, Tesla's a great example, they really suffer when the cost of borrowing goes up. And cash generative businesses like oil companies and banks, they do very well actually. They're the other side of that coin, and that's one of the reasons the UK market's been quite strong, because there's a high prominence of banks and energy companies within the UK market. This is the yield curve. I just took this from the FT today, and it shows a month ago, just after the mini budget, if you lent to the British government for 2 years, 5 years, 10 years, 15 years, how much you got. That's come down a week ago to what we call the orange line, and then the green line is the latest. So we've seen some moderation after the budget, which seemed to be a quite prudent budget. The cost of borrowing for the UK did reduce. What you'll see is that you can get really good rates at 6 months, and if you go to a bank at the moment and deposit on a 6-month basis, I think you can still get nearly 4%. I don't think that will last. It's a bit of an anomaly on the curve, but that we've certainly identified that in the short term as quite an attractive area for yields, just lending for a short-term period. And that's market suggesting that rates will go up, but we're probably near the top of the cycle at the moment. I mentioned the markets were cheap, not the US. This is how many years do you have to own a company for on average to get your money back? In the US, it's 16 times, and it has been as high as 22 or 23, I suppose, there. Outside of the US, though, 7 for Italy, 8, 9, 9.2. These are really attractive. And the reason that company prices, share prices are quite cheap at the moment is because the market's expecting earnings to drop into a recession. Typically, when you have a recession, earnings drop. But this recession is going to be quite different because it's backed by inflation. So if a company had the same earnings this year as it had last year, in nominal terms, it looks as if it's maintained its earnings. But after inflation, it's actually dropped 10%. And because of the inflationary effects, there will be a few businesses individually that suffer, but we think earnings will actually come through in nominal terms. With slight increases, the reported season so far has demonstrated that. So just to round off the point I made at the start, these are really attractive PE ratios, and we haven't seen them for quite a long time, with the exception of the US that still looks to us, certainly within the large companies, a bit expensive. And I could just sort of double up on that point. This graph shows how expensive global markets are compared to the US. And generally the US, it's the biggest market, the most entrepreneurial. It operates at something like a 15% premium, or to put it another way, other markets are at 15% discount to the US. But during the period from the great financial crisis, we've seen that extend up to about 30%. And bear in mind that US entrepreneurial companies are more susceptible to higher borrowing costs. We think there's both a stretch in valuations and an underlying force that is likely to pull those valuations down a bit. And I mentioned as well, we've got capital destruction. They're a couple of weeks old, these slides, but isn't it quite incredible to think a company like Facebook, which is the company on the right, its high was 350, now it's down to 222. Sorry, Facebook's on the left, it's Tesla on the right. Huge loss of capital, and it just shouldn't happen because the biggest companies in the S&P 500, they're supposed to be Goliath companies that have huge security, and if they grow, they grow slowly, but more importantly, if they fail gradually. And yet you've seen so much money wiped off Facebook that I read an article that I believe that more people now have lost money on Facebook, now called Meta, than the people who made money as that company grew, because its valuation at the top, the amount of new investment coming in was far higher during that period than it had been on the way up. And I expect that's probably the same for Tesla. So yes, there's been some mild losses or expected losses in markets, but there's been a few areas that were best avoided. So I'll just round off on the outlooks before I hand over to Sam for any questions. This, as I mentioned, markets do look attractive to us. As fund managers, after markets fall, when clients perhaps are feeling a bit bruised by losses, but that's where the valuation is more attractive, and we can still see areas that I've outlined where there's room, we think, for further capital loss, but more importantly, there's lots of assets that now look fairly or even undervalued, and we think the market is mispricing the earnings revisions because the inflationary effect in the background means we think earnings will actually be they won't grow in real terms, but they'll still grow, and on current valuations that's quite exciting. We've seen a lot of fashionable stuff make a lot of money, and the Netflix is always a good example, the so-called FANGs, I suppose, and they've almost been bought more because they're great businesses and great investments, and we still think that looks quite vulnerable. These sort of businesses often suck up a lot of capital, and while it was cheap and readily available, no problem, but that's reversed. We've seen some destruction, and we think there's a bit more to come, but fringes of the market that we're not particularly invested in. But we really like these stocks that are cash generative, with on low PE values, and that's where we've been building positions. But the best returns will always come from growth stocks, but not the old growth stocks that have matured. It's looking now back to smaller companies. Things are changing. Those businesses that recognize change and adapt to it, and they're generally smaller, those are now the ones that will be coming through into the S&P 500, for example, over the next cycle. And that's where we want to start looking. We don't think inflation is going to go back to 2% anytime soon. And let's say a typical cycle could be 7 to 15 years. So that's the sort of time frame we're measuring that we expect inflation to remain elevated over. And when you've got inflation, you want real assets. Commercial property looks a bit expensive at the moment because of the cost of borrowing. But if it were to correct, it would then actually become quite an attractive real asset. And so those are the areas that we're looking at. And we particularly find those in UK and Asia at the moment. UK probably know a bit about, but Asia, the demographics there are very strong, great economic growth. And if we see China, as it appears to be, moving more westward than towards Russia, that could really unlock some value. And I'll just make a point on that the Chinese and Russian economies, so Chinese and American economies, are so interwoven in supply chains and their reliance on each other. Actually, it'd be sanctions haven't really hurt Russia internally, but for China, it'd be completely different. And we do see China sort of pulling slightly away from Russia as a result of this invasion. So I'll start sharing there. Can I hand back to you?
Yeah, sure. Yeah, thanks for that, Toby. Anyway, so we've had a couple of questions which have come through anyway. So first question, which is quite a sort of topical area of investment over the last sort of year or two, is what has happened to crypto assets and what is the outlook going forward, would you say?
Right, okay, well, I mentioned fashionable assets have really got beaten up, and I put the cryptocurrencies in that category. Like all bubbles, and we're going to say that this is a bubble. It might turn out it isn't, but we firmly believe that crypto has been a bubble. You need an asset which is sort of easily tradable and almost nobody understands it, and that's what allows you to get these sort of incredible valuations. I think about tulip bulbs in the 1600s and railroad stocks in the 1800s, and this is similar. And the problem for us with crypto is it doesn't do anything. It doesn't create. There's no income. There's no revenue. There's no business. It's simply you buy it with the expectations that somebody else will pay more for it in the future, but there's no catalyst to say why that would be the case. So our view is that the future of crypto is still downward from here. Strangely, when you look at the the tech crash in 1999, about 10 years, about a decade after you get these big negative events, usually you get something emerge from it that sort of renews the idea, but in a different way and is more interesting. And I think there may be a place for crypto, but it will be regulated and government backed, and it might occur from the ashes of what happens next. But we're probably 10 years away really from having any interest. a dig, if I can make it. I don't know if everybody will smirk at this, but the big banks, BlackRock and Goldman Sachs, said the same for years, and then they capitulated and decided that they would put their clients into crypto, and the capitulation was pretty much at the top of the market. So the wisest, in theory at least, the wisest and best paid analysts in the world, got this completely wrong, which shows how tricky it is. But I think generally, if you don't understand something, then you avoid it and look for things you can understand.
Yeah, I mean, I suppose it's a very complex area of investment, isn't it? But there must be some sort of technology or knowledge that has been learned over this process that can be used for something, maybe as you say, in 5 or 10 years' time, whether it's the blockchain technology in terms of how they build these things or something. But we'll watch that space and see how it develops, I think, anyway.
Yeah, I agree.
Good. Right, another question come through is, where do you think that interest rates will top out, and will they ever go back to the level seen over the last sort of few years?
Right. Well, I was always told not to make predictions, but I think it's fun in some ways to sort of nail your colours to the mast. I don't think we'll see interest rates back to where they were in the rest of my career, at least, and probably those that even stretch up to the youngest people in our team, in our teams. You need a very tranquil world with huge amounts of trust, and for that to occur a long time, and then allow the condition for quantitative easing once more to build. And the idea of getting there from here just seems a very big stretch. So I don't think so. I'd like to think interest rates will top out about 4%, as I showed on the graph. What we don't know is there's room here for policy error. Central banks, will they push too hard too soon? Will they make a rate rise and leave enough time to see the effect? It's hard. These are tough decisions, and you wouldn't really want to be a central banker at the moment. But for the UK, I'll say I think 4% was, if they go above that, it will be seen as a mistake and reversed quite quickly.
Yeah, I quite agree, actually.
Sorry, Sam, I'll just add to that point, because maybe this will be of interest. That I think central banks have never had to make a difficult choice so far, because inflation has been fairly benign. Independence of central banks is only recent. It was 96, I think, when the Bank of England became independent. But let's say inflation is coming down, but it's still stubbornly high. But it is coming down. But the economy is moving into a deeper recession. Do you raise interest rates and keep your inflation target, or do you provide some relief for economic growth? And central bankers may feel that their mandate is just to focus on inflation, but I think you'll find governments reassert some authority over central banks if it becomes really unpopular. And so I think they'll only deliver a mild recession, because it's pointless really delivering anything. If you're targeting inflation, a mild recession does as much as you can do, and then you sort of want to encourage as much economic growth as possible after that.
Yeah. Okay, good. And just lastly, so what average return could be expected from a medium risk portfolio over, say, the next 5 years?
Well, I think because valuations have come down, I think that expected return has gone up. So if we say the 5-year risk-free return is probably just over 3%. So for taking a level of risk and with some decent management, I'd sort of think somewhere 5 to 7% would be where I'd expect it to come out for a competently managed portfolio.
Yes, I suppose someone who has cash now going into the fixed income regime that we're now on in terms of today's prices compared to where we were, that's meaning your non-equity element is going to be getting more of a return, isn't it, basically? And then combining that with what you can get from equities over the next 5 years probably makes it quite an attractive area to be investing, would you say?
I think cash is a lot more attractive than it was. Yeah. But then, and so the return from cash has gone up. But equally, the inflationary pressures have gone up more. So you're actually worse off, even worse. Well, let me say this, get this right, Sam. cash is even worse than it was, because although the rate of return's gone up, the inflation pressure's gone up by more than the increase. So I think the actual pressure to get higher returns will come back, because although I can fully understand why people will be attracted to cash in the short term, actually it's still not enough, and you do need those higher returns to grow spending power in real terms.
Okay, great stuff. Well, I think that brings the webinar to a conclusion. So thanks very much for your presentation and input, Toby. And thank you everyone for joining the webinar today. If you have any other questions, please feel free to contact either myself or your contact at Clarion, and we look forward to seeing you at the next webinar. Thank you very much.